All right, so work through these definitely. It is tedious and it is kind of hurts your head at first, but if you work a couple, it'll start making some sense. Make sure to email me or let me know. Um, if you're having some issues, I can help walk you through them. I want to talk a little bit about. I mentioned this is in the next part of it, the next part of chapter 11 notes. I want to talk about changes in estimates. At least I won't get into so much a correction of the errors. I'll probably end the talk today with changes in estimates because it's something that's very common, right? We acquire something, and if it has a 15-year life, first we're estimating, okay, we bought this today, we think we're going to use it for 15 years. That's a pretty bold estimate, right? I mean, we might use it for 15, it might come up short, it might go a little longer, but our best guess today is 15. Same thing is if we try to estimate a salvage value. How much do I think I'm going to sell it for at the end of what I estimated would be its useful life? So through no fault of our own, through no bias, we make an estimate based on our best information. And then as we get into the thick of it years later, we recognize that perhaps our best estimate needs to be updated. So when that happens, yeah, we're going to have to do some changes in our depreciation estimates over time. When we have a change in estimate for any change in accounting estimate, and there's a lot of accounting estimates. So it holds true for any change in accounting estimate. Right, we've looked at an estimate of sales returns, an estimate of bad debt. We've estimated write-downs for our inventory and things of that nature. When we change an estimate, we only need to change it going forward. We don't go back and restate or adjust prior year's estimates. We do need to make a disclosure in the footnotes, especially if the amount is material. And then we need to talk about like, well, what is the impact on the income statement and where it fit into having an effect on this year's income. So for depreciation, it would be certainly disclosed in the PP&E footnotes. It would, say basically last year our depreciation expense was based on an assumption of X number of years. We updated that to Y number of years. This is the change going forward in the depreciation expense that we're going to recognize per year. Right. So pretty straightforward. I'm going to show you an example of this. Suppose that we have a company, Hookem, they use straight line in the middle of the third year of the asset's service. Hookem determines that it'll be able to use the machine for 7 years, but will only realize a salvage at the end of those 7 years of $75,000 on disposal. So this was the original factors that we had going into this asset. If we're using straight line, we're in the middle of the third year. So we've already recognized the first and second years of depreciation. Therefore, my first step is, what is my book value at after the first 2 periods of depreciation? Well, with straight line, right, pretty simple, $450,000 cost less the salvage of $100,000 divided by the useful life of 5 years tells me that I'm going to recognize $70,000 of depreciation expense per year. So if I'm trying to figure out the book value of this after 2 years of applying that depreciation expense, what it would line up to be using T accounts, because they're always super useful. We'll just say it's equipment. I don't think I'd say whether what it is. Accumulated depreciation. So my historical cost doesn't change. It's 450. The accumulated depreciation would start at 0 in the first year. I'd recognize 70. It would come up to 70 at the end of that first year. This would still be at 450. Then I would recognize another 70 in year 2. Now it's at 140. And this is still at 450. So at the end of the second year, that's the end of the first year. But at the end of the second year, I have a book value of 340. So that's my book value at the beginning of the third year. And then all of a sudden I have a change in what I believe I'm going to, or how much longer I believe I'm going to be able to use this item for. So the way to determine how that's going to change is by recalculating the allocation base with this book value. What I'm looking at now is, all right, this has a value of 340,000 that I have to spread out over its remaining useful life. Now, remember, the allocation base is only going to spread the non-recoverable cost. So I'm going to subtract off my salvage value, but my salvage value changed. It went from 100, and now we believe we're only going to be able to get $75,000 on disposal. So the amount of money I want to spend is, or the amount of money I need to expense through the allocation base is 340 minus 75, which comes out to $265,000. So someone asked, where did I get the book value of 340? Remember that book value is the balance sheet value. It is always the ledger account minus its contra account. So 450 minus 140. Oh, shit. That's another miscalculation. That's why you're probably confused. Calling me out left and right today for good purpose. It should be 310, not 340. Does that make more sense? 310 minus 75. 235. So using that book value and subtracting off the 75 gets me to the allocation base of 235. Now the question becomes, remember, this is the non-recoverable cost that I still have to expense, given that my salvage value dropped a bit. But remember, I'm also going to be able to use the machine for 7 years instead of just 5. So I would use my fingers to count, because I see people do this wrong on the exam a lot. We're in the middle of the third year. So that's the third year has what is 1 year of depreciation remaining. The fourth year, the fifth year, that would have been the end of the original useful life, would be the 5th year. But then if I'm going to get it for 2 more years, we add a 6th year and a 7th year. So it's back to 5, right? We're going to have it for 7 years in total. I've already used 2 of them up. And so I have 5 remaining. And I take the $235,000 I want to spread over those 5 years. And that gives me my new depreciation estimate, which comes out to $47,000 per year using a straight line method, right? So it changed. It was recognizing 70,000, but in the middle of the third year, we had some updates. We found out we're probably going to get less of our cost recovered when we sold it at the end of its useful life. And then we found out we could use it for an additional 2 years. So we subtracted off the 75 from the remaining amount we had to allocate to figure out what the non-recoverable cost was going to be. And then we just determined how many years we have to spread that over. And because we're in the third year, we still have 5 years remaining if the total useful life is going to be 7 years. Okay. Like I mentioned, don't worry so much about the correction of the error. At this point, that becomes a little bit over the top. When we change allocation methods, this also is a change in estimate. So we don't have to worry about going in and doing a much more laborious change, which is if we changed accounting principles. And one of the examples that I have in the cases has this actually going on. Case number 3, this is also in that same document that I put up there, put up the extra problems. This would be something that I would definitely work through. And it follows the same idea as what we do when we change estimates. We want to figure out what the book value is in the year of the change. And then we figure out how we're going to, what we're going to need to do in order to recognize the full allocation base over the remaining time. So I'll look at this one and we'll wrap up on it. We have a manufacturer of snowboarding gear. They are purchasing new machinery, new production machinery for $650. It says the machinery costs $20,000 to install, $5,000 for trial runs, $10,000 to train employees. So these are sort of chapter 10 facts. Do I capitalize it? Do I expense it? That's going to, that will essentially establish what the acquisition cost of this item is for the company by deciding whether I capitalize or expense. And then it goes into the information in chapter 11. We can get $50,000 in salvage at the end of the machinery's useful life of 5 years. They intend on allocating costs using double declining balance and switching to straight line in the third year of the machine's useful lives. So they're going to do a change in estimate in that third year. So the first thing I need to do is apply the chapter 10 concepts and figure out how much I want to record as the value of my machinery. If all of these are cash expenditures, then I want to capitalize the 20,000. I want to capitalize the 5,000 trial runs, the installation costs, both get added to the invoice price. So that would be 675,000. And the training would just be an expense. We don't capitalize costs of training our employees. And so that comes out to $685,000. All right. Now we have the appropriate acquisition cost. And that is important in determining my allocation base. because I have a salvage of 50,000. So this is the amount of depreciation that I want to recognize over the 5 years. Right? Now, how much of it in any given year depends on the depreciation method, right? Accelerated methods will recognize more in the first years. Straight line will take it evenly across all 5 years. So this company says they allocate by double declining balance and then switching a straight line in the third year. So for the first 2 years, we're going to apply double declining balance. And the declining balance method is the one method that ignores salvage when it is initially setting up its estimates. So it just takes the book value of the asset at the beginning of the year as its way of determining the amount of expense. The book value is 675 because there is no accumulated depreciation at this date. So if accumulated depreciation equals 0 at that date, it's just the full historical cost. Now, what makes it double declining balance is that the declining balance method asks what is the straight line rate expressed as a percent. And the way you get that is just by understanding that I'm going to divide up 100% of the allocation base over the course of 5 years. And so the straight line rate is 20% per year. If I was going to apply straight line, I just applied 20% of this amount every year for 5 years. But because I'm doubling that, I multiply it by 2. And so it assigns a rate of 40% of the value of this item. So that becomes the rate that I use under a double declining. If it were triple declining, it would have taken 20% and multiplied it by 3. If it were like 1.5 declining, then it would take 20%, multiplied by 1.5. So there's different types of declining balance. It's just how fast do you want the normal rate to be multiplied by, right? So 675 times 40%, that tells me what my depreciation expense would be under the double declining method for the first year. It ignores that salvage, which tends to be a mistake people make. So be careful with that. It takes the full 675. So if I recognize 270 depreciation expense and I got my, my T account set up, equipment or machinery, same thing really. Accumulated depreciation would start at 0, gone up to 270. I have this equipment at 675. And at the end of the first year, then that would be 270. The equipment would not have changed. We don't mess with this a lot. We might a little bit, and we'll talk a little bit about when we do. But 675 minus 270 gives me my book value at the beginning of the second year. If accumulated depreciation is now 270, then my book value is 675 minus 270, which gives me 405,000. I multiply that by 40%, and that's my second year depreciation expense under double declining, which comes out to 162,000. That updates now 162. Still 675 here. So now I have a book value in my third year, 675 minus 432. And that would be 243. So now I've done what I did in the last problem. Basically, I've derived my book value up to the point of the change. I decided I was going to switch to straight line in the third year. So this is the beginning of the third year's book value. If I'm switching to straight line in this year, then I need to take the book value. That's my total amount that I have yet to expense. I decide, well, how much of it do I want to expense? Remember the non-recoverable amount. So if I still have a $50,000 salvage, I subtract that off of the remaining amount. And that gives me my new, all right, well, my non-recoverable cost is $193,000. This is what I absolutely need to expense after I take into account that I estimate I can earn $50,000 selling it at the end of its useful life. How many years does it have remaining? Well, it had 5 years in total. We're in the third year. We haven't applied depreciation expense for the third year. So we'll have year 3, year 4, year 5, 3 years. So with straight line, then I just divide this over the remaining 3 years. And it comes out to 64,333 repeating. That would be my new depreciation expense at year 3 under straight line. And that would just progress forward because now it's straight line. That's the amount of depreciation expense for year 3, year 4, and year 5. And when I apply that 3 more times, I will get down to my $50,000 salvage at that point after I've done this 3 times, because I will recognize 64,333 expense every year for 3 years, comes out to $193,000 of expense recognized. That will reduce my book value down to $50,000. So that's how you modify it when you are, it's the same idea. Like I mentioned, you're just getting, well, what's the book value in the year I change the estimate, determining, all right, if this is my book value at the year I change, well, how much of it still needs to be expensed, which will depend on how much you think you can recover, and then spreading that out over the remaining time period using the depreciation method that either you had or the new one that you're switching to. So that's where we'll end today. And I will stick around in case y'all have any questions, but thank you guys for joining, and I hope to see you on Thursday.